my friends. Chris Marcus here with you from Arcadia Economics on Friday, March 16th for this week's weekly wrap-up and some interesting things happening in the bond market that are really going to affect the other markets. And with that said, let's dig right in here because next week coming up, we have a Fed meeting, always a hoot. And interestingly enough, a quarter point increase in the short-term interest rate is priced in to the degree that some are actually even debating whether the Fed would raise a half point next week. One measure suggests 1 in 9 chance of half-point move, which I don't know, maybe probably I would think would be even lower than that. It's hard to imagine the Fed raising 50 basis points. But I do imagine they'll raise a quarter point. And what's the big deal? Fed, interest rates, this, that, they're always out there squawking. And in the end, what does it really matter? Well, fortunately, in the last couple of months, we've had a great example because you saw here, this is from Tuesday, March 6th. So following how we've seen the stock market get pummeled a couple times in response primarily to the rising interest rates. So here they're saying investors took $41 billion out of the market, the stock market, primarily in response to the rising interest rates and what they label inflation fears. I don't know what else you're waiting for if you look at home prices or anything. But again, it was interesting because when Chairman Powell was speaking, it was one of his congressional testimonies. And as he was speaking, he implied that, or at least gave the impression, as it was perceived by the market, that he might raise rates faster than others had expected. And actually, if you look down here, the yield actually spiked while he was talking. Let's take a quick look at the yield. Here is our one-year chart. And as you can see, so really over since September, when it was down at 2.05%. It's gone up quite a bit since then, nearing 3 until the last month. It's stabilized a little bit. So still at 2.84% today, yet you have another interest rate cut coming. And it's interesting just looking at how quickly the stock market is reacting. So we saw that in February, the investors took a lot of money out of the stock markets, and then here's a story from today. Investors just pumped the most money ever into a stock fund for a single week. So you can see money is moving quickly, as well it should be, because there is a great wealth transfer going on right now. As we'll point out in a second, beneath the surface, there's a lot of things happening that are ignored often on Wall Street and Washington. But you see how quickly the money is moving. You saw last year how quickly money moved in the crypto sector. And why I point that out is just, a lot of the time it looks like things are just stoically going along, yet we're seeing that as things change, money can flow quickly, despite the cryptos getting pretty thoroughly pummeled again this week, amidst rumors of some shady business from this, the trustee of the Mt. Gox exchange, apparently slamming a large amount of Bitcoins in a block offer, similar to what we've always heard from gold and silver markets. Whether that's actually the main cause for that move, I'm not sure, but one of the reasons I've heard presented that at least is plausible enough. But again, you see how quickly the markets move, how volatile they are. And why is that worth keeping an eye on? Because again, there's all these things that can happen in the short term. The Fed might raise rates, lower rates, yet in the end, what hasn't changed is that they still have the massive balance sheet. Rates are still below 2% a decade later. And now the discussion, as the debt has crossed over 20 trillion, we're seeing the $30 trillion debt dilemma, primarily because it's over 20 trillion and all we keep hearing about is increases in spending, trillion-dollar deficits. Keep in mind that the debt load doubled under both Bush and Obama. And while I do believe there's a lot going on beneath the surface of whatever is going on inside Washington that we don't quite fully see, you know, you just look at the numbers and look at that chart there, which is really pretty stunning. There's the date. So you can see really as very similar to the crypto chart. Here's 1980. It looks like about $1 trillion here, and then has really just accelerated with no end in sight. Again, when the government is shutting down, these aren't even battles about whether to cut spending, but what rate to continue increasing it. So, you know, you add all these things up and you have this massive debt load, you have rising interest rates, and the Fed is saying they're going to continue unwinding their balance sheet. So if these things happen, that's going to be not such good news for stocks and real estate, which is why in the end, if those start tumbling again, I still think we'll see more Fed money printing. And what would be another response? Certainly, we've talked a little about the cryptos. Again, there's gold and silver, which seem like watching paint dry, yet beneath the surface, Ted Butler is reporting, which you can go and see on the COT reports for gold and silver. But he's been reporting for a while. He estimates that JP Morgan is up to about 700 million ounces of physical silver, which I believe is close to almost, 30, 40, almost 50% of what's known as the above ground investment grade and bar form amount of silver available. And JP Morgan has close to half of that, according to Ted, who I find to be pretty accurate, well researched. Also noting that Goldman Sachs is showing up on those reports. And again, just from my experience on Wall Street and the financial world, you read a lot of stuff, but also if you pay attention to how some of these banks are acquiring their positions in conjunction with all the other things we've discussed that have been going on in the silver market. So here you have the big boys again loading up. At the same time, deficits are out of control. People have as much as the cryptocurrencies, and we'll take a look at our price today. There we go. So about $8,500 for a Bitcoin. Still down, obviously, over 50% from its $20,000 high. Yet, if you bought a Bitcoin at the beginning of 2017 for $1,000, or even earlier for less than that, keep in mind that it's still up quite a bit. And with that said, I've mentioned several times, we'll probably continue to say the same thing. The one thing you can expect is incredible volatility. We're seeing that here. So I don't see anything that's changed the underlying fundamentals or that have led me to acquire the cryptos that I have. So I'm certainly planning on holding through this period. And I think that we're going to top the previous highs in the not too distant future based on everything I am seeing. Hopefully that will be the case for gold and silver as well, although we're quite a ways away. Gold $1,300, silver about $1,630. And again, with the precious metals, my estimation of what we'll see happen is that basically they'll flounder around in these ranges that we've seen until eventually, let me put it like this. This is, again, based a lot off of Ted Butler's work, although having thought about it for about a decade and doing my own research, I think that this is somewhere the general premise of how it will go. Either A, you have enough people show up for metal and say, I want my physical metal, it's not there to deliver, so you have a short squeeze, possibly what's often referred to as a force majeure on the COMEX, which would essentially be saying the COMEX, I don't know if you would call it a technical default, but inherently a default, because what's interesting, as David Morgan and others have reported about those contracts, is that if the COMEX can't deliver the physical metal, I believe they do still have, according to the legal wording, the ability to say, all right, we're giving you cash. So let's say silver is trading at 17 bucks. You have a short squeeze and the metal's not there. They'll give you your $17, the last price it was trading at in their system. Yet, if you want to go out and buy a piece of silver, it might be $50 or $100 at that point in the event of a short squeeze. Now, the other possibility would be, as Ted has reported, that essentially each time the market has rallied, there's a ton of paper contracts written to short the market. So basically, you could have, no matter how much buying demand there is, you can keep selling, you just add zeros, which essentially is what I believe has been occurring. Although what we've always wondered, I say we, myself, Ted, a lot of others in the gold and silver community, is at some point, would the banks stop doing that? And certainly when you see the banks, again, Goldman and JP Morgan, reportedly buying large amounts of physical metal, well, at least that's one incentive in place where if they're benefiting from the price going up, at least one factor to believe that, the price could go up quite a bit. And when that happens, I still think more than a 50% chance in 2018. Seems like with all the things that are happening, that things are building, and you wonder how much longer this can be contained. Although, worth factoring that when you're deciding how to invest or how much money to put in different places, factor in that while there's a good chance it could be this year, it could be next year or a couple of years further down. So I look at gold and silver really as a great form of savings. I mean, they're basically at the cost it takes to get them out of the ground. So if there's a limit on how much lower they can go, because let's say silver goes down to $10, which I don't think is going to happen. But if it did, people aren't going to pay $15 an ounce to dig it out of the ground and sell it for $10. So you have less supply on the market. Again, the market's way of naturally keeping its equilibrium. And, in that scenario, you would be creating an imbalance that eventually, I continue to believe, will be resolved with incredibly higher prices. You just add all these things together. They're not happening. I mean, they are happening individually, but when you see how they're fitting together, the fact that the largest creditors who are funding this massive debt to this point, so have been the Fed and China. Fed is supposedly going to stop buying the debt. China has been speculating that they are not going to continue buying the debt, which means you have a problem here. And that's the main issue, is that no matter what is said, that elephant's still in the room, and just be patient is my strategy, especially on the cryptos and gold and silver, as we see a system that has reached its breaking point or is very close to its breaking point. And we're transitioning and seeing the wealth shift out of that. So I'm hoping that I'm on the early side of that. I believe that I am. We'll keep you posted going forward. Always exciting stuff. Leave your comments below. Thanks for watching, and we see you again next week.